Welcome everyone to this Friday webinar. We have been doing, webinars with many long only fund managers and understanding their perspective on markets, who ought to be always, more or less bullish. But we have been seeing, some kind of, I would say, consolidation happening across the sectors, and markets are generally cyclical, but they have shown one side trend upwards for a very long period of time. And it's like in last 1.5 months, we have seen markets are kind of trying to test whether it can go up from here without growth in earnings or not. And yes, last 2 quarter results have also been kind of relatively dismal, and that is where markets are range bound right now. But today's day was little different, and many fund managers who are taking cash calls have been surprised, and many fund managers who like were sitting on cash and were kind of thinking that like markets could fall, but markets have surprised and shown and demonstrated that market is above everything. Having said that, at investor level, it is important to understand, the asset allocation and kind of make portfolio scientifically in such a manner that one is able to have a long-term perspective. And keeping that in mind, we try and do webinar with different kind of fund managers. Today we have Mr. Puneet Sharma, who is CEO with Whitespace Alpha, which is like well-known fund house based out of Hyderabad and has been delivering well in the space of hedge funds. They manage two strategies. One they call as Debt Plus, which is a substitute of debt kind of products towards fixed income, and then is Equity Plus. Both products try and aim to hedge and try and give alpha. And in this webinar, it is my endeavor to understand from Puneet, what is it that kind of differentiates them from the rest. Welcome, Puneet, to this Friday webinar. We do such webinars every Friday, generally for our education and understanding, because at the end of the day, we want our investors to invest in the best and also make well-informed investment decisions. So we are not going to do any sales talk, but obviously, you want to understand the product in depth. So, formally, I'm kind of, now handing it over to you to give your opening remarks on what is your differentiation and what are your kind of, what is your story so far, and how do you propose to add value to investors?
Right. So first of all, thank you so much for having me. I'm really happy to be here on the webinar that you're hosting. And obviously for everybody who has joined in, thank you so much for bearing with us for the first few minutes when we had a bit of a delay. So Kamal, as you very rightly pointed out, there are market variations which keep on happening on a day-on-day basis or a week-on-week basis, or even on a slightly longer duration if you start looking at it on a month or a year basis. So this is something that we're trying to avoid, trying and timing the market. That's something that we have been trying to avoid for the past 10 years since we have been in existence in one form or the other. Very cool segue into our history. So we started off about 10 years ago when we started developing strategies to generate a bit of money on a month-on-month basis from our underlying investment. And our underlying investment went straight into equity stocks, which we picked up as a passive investment. So the best passive investment that we could think of was Nifty 50 investments. So the 50 best stocks in India, the 50 largest companies that we have trading in India, that's what we started off with. But given that we always had an itch of doing something more than what the market is doing, so we started developing strategies which will give us a monthly cash flow in a slightly jovial way to run our daily month-on-month expenses up of our households. That's what we were aiming to generate out of the market on a month-on-month basis, while also building on the investment on the underlying equity stocks. They will continue to grow at the pace which India is growing at, or far outpace India as well, in terms of if you're looking at Nifty returns somewhere between 12 to 15% annualized over a decently long enough period. And by that, I mean somewhere around, let's say, 5 to 7 years. So that's the philosophy that we go with in our equity plus offering, and very similar vein on our debt offering, where we are talking about more of a conservation of capital or a stability of returns coming in from the interest income that we get. But again, use the same strategies and generate an alpha over and above. So that's how we came about. And today's market, or the recent moves of the market, are, I think, the prime example of why such a investment strategy or a philosophy is possible or actually works in these kind of times. There are market movements that people will want to invest into the market when it is sitting at 24,000 something. would want to exit when the market is at 26,200, but you never know what the market is going to do. It's very foolish to really try and predict what the market will do and assume that you are going to be right 100% of the time. So if you're not going to be right 100% of the time, it's a lot better to just be a passive investor in the equity market. Invest and hold and bank upon the capital appreciation which happens from the equity markets.
Right. Why do you call yourself as alpha focused? Your name is Whitespace Alpha. On one side, you're saying you're a hedge fund. You're trying to control the downside. Also, you're trying to say that you're alpha focused, which means you're trying to outperform. How can both these things be, I would say these promises be executed together?
Kamal, very good question. So we are called Whitespace Alpha. That was what our objective was when we started developing our strategies as well. So the strategy itself is focused on generating an alpha over and above the Nifty returns or over and above the GSEC returns that we have on the month-on-month basis anyway. So our entire strategy is a very hedged strategy. So we take zero equity exposure in the derivatives market. You can go long on the derivative side, short on the derivative side, but we net it off completely. We take zero equity exposure out of that derivative market. So that's where we are hedged fully. We are not hedging our underlying investment, but that generates that entire return that we expect from the equity markets to go on. But on a month-on-month basis, we generate or overperform the Nifty index, outperformed by the alpha that we are generating on a month-on-month basis. And that's the objective. So we're trying to generate the alpha on a month-on-month basis. That's why the name alpha in our thing. And the closest you can have to a hedge fund in India is a category 3 AIF, and that's what we are. That's the hedge fund that we are running.
Sure. What are the kind of clients you cater to, and what kind of investor needs they come up with? Because we understand, yes, there is a fixed income and as an asset class which fulfills the need towards safety and needs towards predictability, needs towards liquidity, all the liquid returns, and then we have equity which delivers long-term wealth creation, obviously, which is maximization of returns.
Right.
Your specific hedge fund, which is a long-short fund, we understand it's a new alternative asset class, but I want to understand from you, when you have created this product, what is the kind of target investor profile you have, and what kind of investors you already practically cater to, and what kind of needs you fulfill for them?
Sure. So let me break it down into two parts, given that we have two schemes on the separate end of the spectrum. So at the first end of the spectrum are investors who are trying to invest into the equity market and hold for a long term. Those are investors who are banking on the India growth story. That's what we bank on as well, who want to capitalize on the long-term growth of the Indian equity markets. That's where our equity plus offering comes in. So we generate the equity returns coming in from the equity markets, like the Nifty 50. But on top of that, once we are making an alpha on a month-on-month basis, that compounds over the period of holding and gives a superlative return compared to the Nifty returns on a base basis. So that's the kind of investor that we are hoping to attract to our equity plus offering. Essentially, those are the kind of target audience we have, which have the holding capacity for, let's say, 5 to 7 years in the equity market. But they want to generate stable but capital appreciation returns from the equity market. On our debt side, there are a large number of investors who do not want to take the risk of the equity markets, given that we've been close to the all-time high. I think right now we are about 5% off from the all-time high of Nifty. It appears that the equity markets are very overpriced and potentially looking at a correction in the market. So those are the kind of investors who, for a short period of time, are looking to generate returns, at least matching the returns that are available on interest generating or fixed income generating securities like an FD or a GSEC or something. But there also, if we can add a value in terms of alpha on a month-on-month basis, and that's the kind of asset that we are looking for, or that's the kind of investor that we are looking for in our debt plus offering. That works best for short duration or a medium-term duration kind of an investment. And the more important part is that it comes with liquidity. So anybody who's looking to invest in a debt product, rather than an FD, it makes more sense because you generate returns of an FD plus additional returns coming in from the alpha strategies, but have a lot of liquidity of options available, unlike a fixed deposit.
Sure. So, you want to cover maybe debt plus strategy first, because today we have a lot of options towards equity.
Right.
People, when they invest in equities, they can look for funds with low beta and try to have a fund which has a deep track record. And after having seen how equity products have performed during various phases of drawdowns. But yes, with regards to debt today, the options are like limited, and it will be more interesting for me as well to understand, what is your debt offering like, and what has been the pattern of performance when you say it's like
Yeah.
month on month giving, positive returns, and in the hands of investors, how does it work out? If you want to spend some time in explaining maybe specifically on the debt plus strategy in comparison to other debt alternatives.
Okay. So the other debt alternatives I'm considering when I'm talking about this are more in terms of fixed deposits or investment into G-Secs or liquid funds or similar investment, which will yield you at current interest rates about 7% annualized pre-tax. Now, in the debt fund, what we're doing is that we're aiming to generate that 7% by investing into the same asset classes, by investing into fixed deposits or G-Secs or T-bills or liquid funds, whatever is allowed under our PPM as well as the regulations. Now, by pledging these, what we are able to do is to invest our or deploy our strategies on the F&O side and generate about 1% a month over and above the returns that we're getting from these underlying investments. So just to put some numbers into context here, so if you're able to generate about 7% from underlying investment annually, we're aiming to deliver on top of that approximately 12%, which is 1% a month, 12% annually over and above this 7%. So for a total of about 19%. Now that by itself makes it a very lucrative product for any investor who's looking at a stability of a debt investment, but wants a little more in terms of returns that come to him. Obviously, we are a Cat 3 AIF and taxation is at the fund level and there are expenses as well. But at a net to the investor level, what we are looking at is delivering approximately about 8.5%, 9% net in the hands of investor after all of these expenses are taken care of and taxation is taken care of. Taxation being at the fund level. So, in a nutshell, it's approximately doubling the return that you would have on a net basis by investing into a fixed deposits versus investing into the debt fund that we have. That's the kind of spread that we're looking at in terms of investors coming into the debt strategy.
Sure. So you mean to say, while the gross returns on any other debt fund, which could be FD or a debt mutual fund,
Right.
would be say 7%, and here on net basis, net of taxes, you are trying to aim 8.5%.
Right.
So obviously, this is like decently attractive for
Right.
debt investors, but debt investors particularly are wanting to know what are the risks, because
Right.
for this kind of an asset class, the foremost criteria and foremost reason to invest in fixed income is to kind of not contain, not have take any risk. It's
Right.
like in the downside, and returns should be linear, returns should be predictable. How
Correct.
predictable is this 8.5%, and what kind of time horizon is required for this? What are the other, I would say, sacrifices that investor has to do in terms of say liquidity? Because the other debt products like FDs and debt products are like absolutely liquid. They can access those, by just maybe, within 24 hours. So all these aspects are equally important for investors to understand.
Fair enough, Kamal. Let me just touch upon those aspects as well. So, what ends up happening in a fixed deposit is that if you redeem it before its maturity, and the bank is going to charge you a 1% penalty on redeeming an FD before time, as well as the interest rate will be reduced for the period that it was actually invested for. Let's say if you did a 1 year FD at 7%, half year FD is, let's say, at 6%. So they'll give you interest at 6% plus a penalty, or they'll further reduce it by 1% to bring in that penalty. So you make a 5% kind of a return, annualized 5%. On top of that, you end up also paying the taxation. So that's the liquidity disadvantage that an FD has. But obviously, like you mentioned, you can go to the bank at any given day and say, I want to break my FD now and get my money in my bank account. For our fund, we have a monthly liquidity available where there's a pay in and a payout which happens on a month-on-month basis. There's 1 day for pay and payout, first of every month. But Here, the benefit is that you don't have to pay that 1% additional or lower on any expenses or higher on any expenses if you redeem it at any point of time. Now, one more thing that you touched upon is the consistency or the predictability of returns. Now, I think the absolute proof is in the eating of the pudding, right? So, for the past 10 years, we have been delivering positive alphas on a month-on-month basis. This has been there approximately out of 120 months for 117 months. So there have been only 3 instances where we actually delivered a marginally negative on the alpha side. So the rest all 117 months we've been positive on the alpha. That brings in the consistency that we have in terms of the alpha that we are delivering from our strategies. That when you stay obviously invested in the fund for a longer time, the compounding also has a significantly more important impact on the overall thing. Now, also, I would like to point out that no debt investment is same in terms of the risk profile that you have. Now, our underlying investments are in the safest debt investments that you can really have, which is essentially your fixed deposit with the largest banks of India, such as HDFC, Axis Bank, ICICI Bank. Or more likely, the investments will be with the government of India in form of G-Secs and T-bills. Now, if you are picking up an investment into a corporate bond, which probably is delivering something about, let's say, 10 to 12%, you are taking a risk on the corporate compared to not taking a risk on the government. Or if the government is actually defaulting on the bonds, we have much larger problems with the economy than the returns that the fund is generating. So, that's the kind of risk the underlying investment has. That's the kind of risk that we have from the strategy, which is approximately 97, 98% positive alpha on a month-on-month basis. That should give investors a lot of understanding of the amount of risk that is there in the system.
Sure, Puneet, what is the kind of asset base and client base you manage in Debt Plus strategy?
So in the Debt Plus strategy, a lot of the investments are for people who do not want to take a risk on the equity markets, or they already have a lot of exposure in the equity market already. Or they're parking capital for a period of, let's say, 3 to 6 months with a perspective expense coming up. A lot of the treasury money also comes into our Debt Plus capital for, let's say, holding period of 3 to 7 months. And then again, there are investors who would rather putting money into a fixed deposit prefer putting their capital with us in our Debt Plus offering. So anybody who's putting in capital into a fixed deposit, our Debt Plus fund is actually a very replicable or comparable product overall with this very similar kind of risk. Now, Kamal, just a couple of seconds more on the risk aspect of this as well. So, very well-known parameter that everybody looks at while evaluating the risk of the strategy is the Sharpe ratio. The Sharpe ratio for our debt fund is approximately, I think, and I'll correct it if I'm wrong, but approximately 2.2%, 2.2, the ratio, which basically means that we're delivering about 2 times or 2.2 times of the risk-free rate of India. By comparison, the Sharpe ratio of Nifty 50 is approximately 0.75 or 0.76. So, yeah, and it's a significantly low risk strategy, very low standard deviation. In terms of the returns also, it's extremely high compared to the risk-free returns that we have.
Sure, there is one question in the chat box which is on the core engine of the fund, or how month on month alpha is generated.
So that's a proprietary model that we have developed. It comprises of 3 key aspects. Obviously, I mean, this is probably not the right forum to discuss it in detail, but I'll be happy to take that on in a longer discussion. But broadly speaking, it comprises of 3 aspects. First is index modeling, where we are trying to capture a small amount of difference which exists between the premiums of the index versus the individual stocks. That's a very well-known strategy. A lot of funds across the world implement a similar variant of the strategy at various levels. Where the proprietary bit of the entire model or the engine that we have that we're running internally comes in is that once the positions have been deployed or once the positions have been taken, we need to constantly monitor of what's happening within the market and individual stocks in order to reduce the risk of the overall trade that we have really deployed in this. And that's the the whole principle that we followed, the entire analysis that we have done in terms of statistical analysis of historical data and continuous live data, that's where our forte really comes into picture, while managing the amount of risk that we're taking in the first principle of the index modeling. So this is a combination of index modeling and statistical modeling combined and perfected over the period of 10 years to deliver the alphas.
Sure, Puneet, let's move on to the equity plus product. How is equity plus product differentiated if compared to, say, mutual funds or PMSs or long only AIFs?
Right.
And what are the, I would say, underlying factors that drive towards alpha, and what has been the month on month or the track record, as you kind of showed for the debt product, like 97%. Here, what is the kind of track record, and how does one understand the quality and the consistency and the risk aspects?
Perfect. On the equity side, as I mentioned, the primary driver of our value generation is investment into the equity stocks. But compared to other large cap funds, long only funds, mutual funds, we do not pick stocks. For us, the investment directly goes into the Nifty 50 stocks. We are essentially running it like a Nifty 50 ETF. We are not picking stocks, we are not picking ratios, we are not overweight or underweight on any particular industry compared to the index. So what it does is that basically we are a very passive investor in the equity or the cash market, and aiming to generate that 12 to 15% return or capture that 12 to 15% return that we expect the Nifty 50 to deliver over a long period of time. That's the underlying principle. And that portfolio is unhedged. We do not really spend any money on or reducing the profit that we're going to get from all of this by hedging the portfolio. Over and above, we deploy the same strategy that I mentioned about the debt fund on the equity portfolio as well. So if the index is going to deliver about 12% in a year, we deliver another 12% from our alpha strategy. That takes the total return to about 24%. And obviously gross levels and expenses on top of that. But that's a significant improvement overall in terms of the returns that you're expecting from equity investment. That's the kind of fund that we have in terms of equity. So the same kind of parameters really work for the equity fund as well. Our track record again is about 97-98% profitability on a month-on-month basis from the alpha strategies on our equity plus fund. Again, 3 months overall in the past 10 years where we had a negative alpha. And the Sharpe ratio for this particular fund, I mentioned that the Sharpe ratio of Nifty 50 is 0.75. The Sharpe ratio of this fund is about 1.86. So it's far outpacing the returns that you get from the Nifty 50 investment at a far lower standard deviation as well. So it's basically reducing the volatility of returns from equity investment while also capturing the equity returns and enhancing it by an alpha on a month-on-month basis. And the real kicker for this is that if for whatever reason the equity market is down, like it was down 6% last month, our fund delivered an alpha of approximately, I think, about 0.6% last month. So instead of being down 0.6%, our fund was down 5.4%. That made a huge difference when the market went up today, because we started off at a higher base. Rather than being down 6% full, we were down slightly lesser and gained more of that. So the compounding really then kicks in.
So as per the experience of last 10 years, as you mentioned, what is a conducive market environment for your equity plus kind of a fund, like the range bound markets or directionally upwards market or directionally downwards market? What is the I would say phase of the market which is, I would say, most conducive for your fund to deliver easy alpha?
There is no easy alpha. Unfortunately, if it was that easy, then it would be replicated quite quickly. But to your point, see, our fund is a very market neutral or market directional, neutral to the market direction. We do not really care about if the market is going to go up or it's going to go down. Like, for instance, yesterday when the Adani stocks were down and the Nifty 50 was down as well, we were making a small amount of money on that day. Today, when the market is up 2.5%, we have been making money on our strategy again today as well. Going back a few months, in the month of June, when the election results were out, based on the opinion polls or the exit polls, the markets were up by a significant number. I think about, if memory serves me right, approximately 6%. And when the results started coming in, it went down about 8.5%. On both these days, we followed the exact strategy of our model. We did not deviate because of whatever news is coming in, because that's already baked into our model right from the start of the month, and continued on the strategy. We made a decent amount of money on both days, when the market was up or the market was down. Similarly, when the market was down magnificently in the month of March of 2020, obviously everybody remembers that the market was down approximately 23% during that particular month. We made money. I think ours was the only fund which had a positive alpha during that entire period of time of COVID. Each month of the COVID cycle, we were positive. That's, I think, the forte of our fund. So it's very disjointed from what's happening in the market. If it's up, if it's down, if it's stable, if it's sideways, like it was for a while in 2023, FY 2023, be it high VIX period of 2020 and 2021, a low VIX period over the past couple of years, we have made money on a month-on-month basis. That's the strategy and the expertise that we have brought into the entire analysis that we have done, which enables us to do this. So there is no particular period or a cycle of a market which helps us deliver the alpha more conveniently. But I would say that our gains are also capped off. It's not the kind of fund which will deliver like a 5% or a 7% alpha in a month. We do not do that. The amount of risk that we take and the amount of money that we make, they're both extremely well capped off.
So if India growth story, which everybody else, 99% of this industry is selling, or maybe, I would say believing or relying upon, if that story happens or doesn't happen, or it gets delayed, or, it has it requires a lot of patience from investors. So that entire thing is not going to impact your fund at all.
On the alpha delivering side, definitely it's not going to impact it, because it's, again, going back to like a 2020 period when the markets were down quite significantly. We delivered on the alpha on a month-on-month basis, the same 1% that we target. But what will end up happening is the debt fund will be fine. I mean, it will be generating the same underlying investment returns of the interest rate equivalent. On the equity side, if it's not panning out, then the equity underlying investment of the Nifty 50 returns will be lower than what we expect it to be. But over a long period of time, and this is a lot of data which has come to this conclusion as well, a lot of the actively managed funds actually underperform on the passive funds or the index itself, or whatever their benchmarks are. I think there was a study by S&P Global, which, not just India, by the way, this is not specific to India. Fund managers across the world have been performing in a similar manner. Actively managed funds, over a period of, let's say, 3 to 5 years or 3 to 10 years, in fact, approximately 67% of them do not beat their own benchmarks. So passive funds, obviously, their benchmarks are very well correlated with the returns that the passive funds generate. That's the field that we want to be in.
So what have been the respective drawdowns of your debt plus and equity plus strategies, say during COVID periods, or any other phase or period that you may remember, or if you want to present or show some data to understand? Because we are basically building the argument that these are protected funds, and at the same time they are delivering alpha on the both sides of markets, and hence eventually over longer term giving a lot of good experience to the investors.
Right. So the maximum drawdown on our alpha strategy that we have in our equity fund or the debt fund, very similar numbers for both of them, would be approximately, I think, about 3% in a month. That's the maximum that we would have ever had. Actually, we had only 3 months. That was one exception, but otherwise, I think our alpha would have been approximately 0.13% negative alpha or something similar. Nothing too materially large to really point out. But yeah, there were instances where we were marginally negative or close to 0%. Even during the period of COVID, all our alpha strategies delivered a positive return on a month-on-month basis consistently. So
equity plus strategy also delivered positive return. That's not
The
possible.
alpha strategy, which is what we are managing on a day-to-day basis, that delivered a positive return. Obviously, the underlying investment, as I mentioned, it's an unhedged portfolio. We are banking on the fact that the India growth story pans out. And so that was our underlying portfolio would have been down the same 23 odd percent in the month of March. But again, I mean, when the market went up in April, so it was also up by about 16%, 17% that the market was up in April. But rather than starting off at an even lower level, I think the equity markets had fallen cumulatively from February to March by approximately 45 odd percent. But rather than being down 45%, we started off at a 50% level. So when you add 16% on top of that, we were at 58. When the other funds, when they were starting off from 45, they were only at 52. So that 6% differential is a significantly large difference between the funds and the other comparable funds within a period of 4 months.
Across both debt and equity, your underlying engine or underlying process is the same?
It's very similar. It's very similar. See, the strategy itself has been developed to utilize the margin availability. It's not really dependent upon what the underlying investments are. So, in fact, we've recently also launched a fund which is a hybrid of the two strategies, which is 50% of my investment goes into equity, 50% of the investment goes into debt. This is more of a balanced advantage fund kind of a comparable scheme that we have. Kamal, obviously, we'll discuss more about that scheme separately before opening it to a larger audience. But so it's very agnostic of what the margin comes in from. So if it's equity, then equity plus. If it's coming in from the debt side, it's a debt plus. So the F&O or the derivative strategies that we have, that is very agnostic. It's very similar across both funds. Marginal differences because of difference in AUMs, difference in execution timing.
Sure. Do you want to share screen and show, month-on-month returns of equity plus and debt plus, because that will kind of maybe give a better picture and clarify. This is a private forum, and we can do that.
Sure. If you allow me a couple of seconds, I'll just pull up the deck with the latest version.
Sure. In the meanwhile, just for everyone's understanding, this entire exercise of webinars that we do is for understanding, and any of these return numbers that Puneet will be showing from their deck, should not be construed as a fund which is right fund for you. It's a matter of consultation, and we are most welcome to consult us to guide you if this suits your portfolio and your risk appetite. Over to you.
Right. So I'll just quickly talk about the fund in terms of the presentation that we usually use. Again, like Kamal mentioned, this is more for education and talking about our fund rather than talking about my specific fund as a solution for your investment needs. Very briefly, we started off in 2015 and got our SEBI license for a Cat 3 AIF in 2019. Since then, been running 3 schemes. Have done a number of other things in the middle as well, including a Cat 1 AIF focused on SSF, the Special Situations Fund or Distressed Assets, an international fund based out of Gift City. We have done a few very interesting deals out of our SSF as well. Currently managing about 2,300 odd crores as an AUM at the AMC level. Consistent generation of alpha is what we are aiming from. And obviously, a lot of this comes from strong operating processes that we have put into place. But as Kamal mentioned, I'll just quickly go to the slide which talks about the returns. Obviously, there are a number of other slides which, in case anybody is interested, we can refer back to. So this is just a quick comparison of our equity fund with the Nifty 50 returns. So the gray line that you see here, and I'm assuming it is visible, is the Nifty 50 returns on a month-on-month basis. And the blue line is what we have delivered at the fund level. As you would note, it replicates the movement direction of what the Nifty returns are, but there is a ever widening gap between the two. That's primarily because of the alpha that we are delivering on a month-on-month basis. And these are the kind of numbers that we have done over the past few months in terms of a quick snapshot of the performance as well. So each year we have delivered an alpha over and above the Nifty performance. There is a month-on-month detailed slide as well. I'll just quickly go there. This is more on the debt side. Again, so as I was mentioning earlier, there were periods of time when the volatility in the market or India VIX was extremely low, hovering at around 10 to 12. That's a very low number compared to what the expected VIX in India is. Expected VIX in India typically should be approximately 15 to 18%. But it was hovering at 10 to 12 levels during this period. And we delivered positive returns consistently during this period as well. When the VIX was extremely high, including the March of 2020 when it hit 64, that period also, the fund delivered on its promise of the alpha generation. Similarly, if the market was down extremely, like in the month of March of 2020, our alpha was there, or market was up dramatically, like in the month of, I don't know, this is sometime during the month of, this is April of 2021. We still delivered an alpha during that month. So it's very independent of what the market is doing during that particular period. Again, as a brief snapshot of the performance, I'll go into the details on a month-on-month performance. Yeah. So this is a month-on-month performance of our equity plus fund. So each month, and the numbers that you see on top are the performance of the fund. So at an annual level, if you want to look at it, so for 2019, Nifty did approximately 12%, while our fund delivered close to 30%, slightly less than that. And in 2020, including the month of, including the entire period of COVID, the Nifty's performance for the year, the calendar year of 2020 was about approximately 15%, while our fund delivered approximately 26.6%. That's all thanks to the compounding of the returns that we were able to generate during the period of the extreme high volatility of COVID period. And so on and so forth. Happy to take on any questions in case there are any, Kamal.
Sure. Puneet. So, we know that in case of both your debt plus and equity plus, the taxation is very different. And that kind of eats away, large part of returns.
Correct.
And all these returns that you're showing are gross returns.
Right.
And net of taxes returns are relatively, lower. We understand in debt plus, returns will come down to, as you indicated, around 8.5%, because that it's 100% hedged fund. But in equity plus, how does taxation work? And that blended tax, at a fund level, how do you calculate that? And what has been a general tax rate, maybe year on year, and what have been net of taxes returns that investors have actually got in, equity plus? And if you can show the same for in the debt fund also, if that's possible, because you ultimately have those numbers because taxation happens at a fund level.
Right, so it's a little more challenging for the equity fund, because what ends up happening is that our long portfolio of Nifty 50 cash stocks that we own, we hold them perpetually. We are not really selling them. So we haven't really realized the gains that are there from the equity portfolio. So we haven't paid long-term capital gains on that, but it will be applicable at a long-term capital gain level. The rest of the income that we generate, it's all categorized as business income, and we end up paying taxes at a 39% rate. At a blended level, I would expect our tax rate to come down to about, let's say, somewhere between 22% to 23, 24% at an overall level. Now, we like to be conservative on the returns that we are projecting and deliver higher. So that is why you see what we are aiming to deliver, and what we talk about when we talk to investors coming into the fund is that we are aiming to deliver a net alpha on a year-on-year basis between the range of 2 to 4%. If we over deliver, that's beneficial for the investor, and that's what we are aiming to do. On the debt side, very similarly, the net return comes down to approximately 8%. The entire interest income that we generate is categorized as business income. The entire alpha that we generate on a month-on-month basis, that is also categorized as business income. After expenses and everything, the tax is paid at a 39% level again on the fund too, or our debt fund, reducing the entire or the net returns down to about 8.5% for the investors.
Sure, Puneet. And you also mentioned that you have reached 2,300 crores of assets. We know, as AUMs grow, even in long only funds, beyond a point, it kind of, impacts the performance.
Right.
So what is that number, for respective funds that, should be kept in mind for investors?
Right. So, Kamal, I think that's a very valid point. I think we have seen that happen for a lot of funds as well. When they start reaching a certain size, then they find it more and more challenging to deliver the alpha. But for us, and this is one slide that really is focused towards addressing that question as well. We significantly invest into development of our model and the strategy. So that is what has enabled us to go from when we started off our equity fund officially under the SEBI umbrella, it was approximately 20 or 17 odd crores when we started. From 17 crores, taking it up to 2,300 crores under asset under management. It's been a journey where we have continuously invested into the model to ensure that we are not lagging behind on the deliverance of alpha. As of now, I do not think there is a challenge in terms of the strategy that we are developing to take it up by another 1,000, 1,500 crores. So that's the kind of AUM headroom that we have at the moment. But again, that depends upon the kind of strategies that we keep developing further to improve this number even more. Unlike a lot of other funds which would aim to take their AUM up very quickly, we have been very judicious in taking up our AUM as well, so that our model is able to keep pace with the changes into the AUM and also the changes in the equity market as well, or the derivative markets as well. I know a lot of people would be very aware of everything that has changed in the derivative market starting yesterday, in fact, or day before. So the derivative market in India is evolving. We are very well adapted to everything that is happening in terms of changes happening there as well.
Sure. So you can stop the screen share.
Sure. Right.
While your specialization is, hedge funds,
Right.
and you're trying to deliver alpha both on debt and equity side. And on equity side, you have kept Nifty 50 as your benchmark. Many investors these days are, going beyond Nifty 50 because India economy is buoyant, and we know, when economy is going to be growing from 4.5 trillion to say 7 to 8 trillion, and maybe higher than that over the next 5, 7, 10 years, investors want to find out businesses in the space of BSE 500 and maybe beyond that.
Right.
Because those businesses are called 5 baggers, 10 baggers, or multi baggers, and investors, in fact, are going towards unlisted private companies also. So, from the point of view of wealth creation in the equity side, investors have a lot to kind of, I would say, experiment. And
Right.
institution also have a 10-year history. I'm sure you're also kind of tempted with all these opportunities. Are you thinking of getting into long only funds in this direction, or you want to stick to your forte and want to stick to the process driven Nifty 50, and then that's Nifty 50 and plus that strategy is what you want to focus and maybe remain here? Because beyond a point, as you also know, AUM limitation will come.
Right.
AUM limitation, you will have to compromise your own personal growth, and nobody wants to compromise one's growth,
Right.
especially after creating name, after having attained some scale and team. How would you kind of bridge this, I would say, conflict of interest, that you want to go beyond your forte or not go? Have you made up your mind? What is it? Because it is important for investors to know, because it happens that investors ultimately give money to fund managers, and then they come up with new fund and then new fund, and we, as I would say, platform, are very investor centric, and we want to address every question of investors beforehand.
Right. So, and Kamal, I'm sure that you appreciated this about us as well. We are very focused on on delivering that alpha to our investors as well, and we highly appreciate your focus on your investors and your client base. So, in that way, so we are very focused on being in that space where we know our skills lie. Our skills lie in the derivative trading side. We understand the derivative market far more than we understand long only portfolios. So as of now, we are not really trying to expand our own horizons and understanding and trying to go into a space which we don't fully understand. And I don't think we'll be able to justify the return expectations of investors coming into the long only portfolio. So for us, we're going to stick to our derivative strategy based investment opportunities. But like you mentioned, there are investors who are very keen on investing into BSE 500, for instance, because it gives exposure to a large number of mid caps and a few small caps as well. So that is why we have the hybrid fund, or the equivalent to a balanced advantage fund, where 50% of the allocation at least goes to BSE 500 rather than Nifty 50. We have chosen BSE 500 specifically for this reason. But that said, in terms of a pure long only fund or taking decisions on a particular sector or a few companies, that's something that we have consciously avoided because that's technically not our forte. We can develop that for sure, but currently I see that there is a significant amount of headroom available for us to expand what we are doing at the moment. So we'll focus on that, keep delivering on the alpha to the investors. At some point of time, when we hit our upper limits on the alpha generation for the AUM that we are managing, we'll stop taking new inflows into our strategies. But that's still some time away as of now. At that point of time, obviously, we'll focus on other aspects as well of business, while ensuring that the current set of investors who are invested in our schemes do not suffer of lack of attention to or any other aspect really impacting their returns or client service for that matter as well.
Sure, Puneet. So let's take maybe a few questions from the chat.
Sure.
I could see there is one question which is on how often do you balance the portfolio to adjust to Nifty 50? What is a tracking error? How do you want to respond to this question?
So we do it on a month-on-month basis. We evaluate if there is any necessity to rebalance our portfolio of the equity holding that we have. Typically, we'll rebalance it on a month-on-month basis because there is usually new inflow which has come in. So that ends up happening by default. Our tracking error is comparable to the largest funds out there, which are ETFs and running Nifty 50 replication strategies. They're very comparable to that. And we've developed all of this strategy or the capability to manage our portfolio and rebalance it on a completely in-house. We do not depend upon any external agency to do this for us.
Is there because the taxation happens at a fund level these days, there are I would say more than 50% of category 3 funds who also show returns net of taxes, whereby the taxes which are like already paid on gains which are already booked. Obviously unbooked gains taxes you will pay eventually, but do you have a slide which shows what has been the net of fees and taxes returns, say in last 3 years, 5 years for your equity plus strategy?
For our equity plus net of taxes, see, it's possible for me to share some specific examples for it. I don't have anything handy, unfortunately, right now, but net of expenses, our alpha over and above the Nifty 50 has been in the range of approximately 4%. But see, it depends upon when the investor came in, what was the actual allocable realized/unrealized income for that particular investor. And we're very fair in that every month we start off with a new scheme, new series of our investment into our equity folio, so that they are not impacted by anything that has happened before they have come into the picture. So everybody gets allocated returns which are only for their period. Any gain, loss, whatever is from the underlying investment in the Nifty 50 or from the alpha strategies, that is all allocated only to that particular period of investment. But there are multiple modes of investment as well. Like you have for mutual funds, there is a direct plan, there's a regular plan. So they differ for each category. They differ for the time period when an investor came in. So to give you a generic return number, I can talk about alpha, which is approximately 4% annualized number, 4% over and above the Nifty 50 returns. That's been what we've been delivering to our investors.
This alpha is on gross returns, not net of taxes.
No, net. Sorry, to clarify, so this is 4% that I'm talking net of everything, net of expenses, net of taxation. Over and above the Nifty return. So if Nifty has done 12% and we assume long-term capital gain, which takes it to about 10%, let's say, give or take a few basis points here and there, and we're doing about 14% overall for that investor on a net basis. That will be the kind of returns that will be for all investors in our equity.
After adjusting broadly 22-25% tax.
Yeah, yes. after adjusting for whatever is the applicable tax. Sometimes we end up paying short-term capital gain because of changes in the Nifty structure as well. So some companies keep coming in, going out.
Personally, you find which of these two strategies superior? Because if you were to kind of invest, and you also have a lot of options to invest, right?
Correct.
So because at the end of the day, it's a personal conviction also. I honestly, if I tell you my answer, I personally find your debt plus strategy to be relatively more logical from investors' needs point of view, because obviously it provides liquidity as well as it provides fixed income, and it is delivering returns much higher than the other relative other option on net of taxes basis. But on the equity side, there are many other options, and we are wanting to be optimistic. But having said that, one doesn't know. Obviously, future is uncertain from the point of view of those investors who are only wanting to invest certain portion of the portfolio in Nifty 50 type portfolio. Your fund has a definite, I would say, edge. But I do not know how many investors really only want to remain investing into equity and would be satisfied with only Nifty 50 kind of returns. That's where I'm asking this question to you. What do you think out of these two strategies make more sense from investors' point of view?
Okay, from my personal point of view, any excess cash that I have available, any investable capital, goes into my equity fund, because that is where the long-term generation of other increase in your wealth happens. The capital appreciation which will happen in the equity stocks will far exceed what you will end up generating from a debt portfolio. But obviously, it comes with a slight downside. There is up and down in the market, like we have seen recently also. So as long as investors have the wherewithal to tide over these ups and downs of the market, I think equity fund is, especially my equity fund, in my opinion, obviously I'm a little biased as well. So that's the ideal investment opportunity that is available for generation of wealth. In terms of stable returns, or somebody who has a relatively shorter investment horizon, then I would recommend a debt fund. But just to give you a bit of a context, a lot of our investors in our equity fund were earlier investors in our debt fund. They saw the performance of the fund month-on-month basis. They saw the movements of the market as well. And then they became very comfortable investing into our equity fund. So they moved their investments from the debt fund into our equity fund. That's been a journey of a lot of our larger investors as well, who have come into the debt fund first and then moved to equity fund.
Understood. No, that's quite logical. I understand that. Absolutely. Thank you so much. I think this was very insightful. We have covered almost everything that, I think it was in my mind with regards to this particular product and strategy. Thank you so much for your time, and thank you everyone for joining for this webinar. For any further conversations and questions that anybody would want to do, we are more than happy to take them one-on-one. You can come to our platform to book your calls with us. We are specialized in the space of alternatives, and some of these products, is area of our forte. There are many things, that are like to be understood at an investor level, at a portfolio level, before taking any decision. So these are all generic talks that we are doing on weekly basis to, arise interests in the minds of investors. At the same time, to give them, some education, because markets are dynamic and there are many new strategies that keep coming up. But that doesn't mean every strategy is suitable to every investor, every portfolio. For that suitability and for that fit, is where I'm saying we can do expert conversation with you. Anyone who is wanting to do a serious conversation for investment decision with regards to this strategy or any other strategy, you are most welcome to book appointment with PMSAIFWORLD. Thank you so much for your time today. Thank you, Puneet.
Thank you so much. Always a pleasure talking to you, Kamal. I'm really appreciative of this time. Thank you.
Pleasure.